There are all sorts of myths about investing, perhaps the biggest of which is that being a successful investor is all about beating the stock market. The truth is that consistently beating the market over the long term is extremely difficult. In fact, only a tiny proportion of investors manage to do it, and that includes the professionals. As an investor, you have a choice. You can either invest actively or passively. Active investors pay fund managers to try to outperform, either through picking stocks or trying to get in and out of the market at the right time. Passive investors, on the other hand, use index funds, which simply aim to capture the market return. There have been numerous academic studies of active fund performance, and they've shown that only around 1% of funds succeed in beating the market over the very long term, once you factor in the effect of fees and charges. Yes, some funds do beat the market in short bursts, but there's very little evidence of persistence. A period of good performance is often followed by a period of poor performance, and most funds eventually revert to the mean. Identifying in advance the very few funds that will outperform for decades to come is almost impossible. So why is the stock market so hard to beat? Well, it's helpful to visualize the market as a giant supercomputer, aggregating the opinions of millions of traders around the world. All known information is already reflected in current prices. It's only new information that causes prices to change, and the market responds within seconds. Every time they buy or sell, traders effectively express an opinion as to the value of a particular security, and thousands of trades are made every second. To say, therefore, that a security is either underpriced or overpriced is a very bold statement. Effectively, you're saying that you know better than the collective wisdom of the entire market. You may, of course, be right, but you're just as likely to be wrong. And remember, to outperform consistently, you need to keep on making correct calls time and again, and hope that any gains you make at least offset the costs involved in active trading. The logical thing to do then is to accept that the market is very hard to beat and focus instead on capturing the market return by investing passively in low-cost index funds.